away with accounting accidentally. This video is called Flying in Style and Capital Budgeting. Flying in style. The airline industry's biggest winners are betting that you'll pay to fly in style. United and Delta dominate industry profits by promoting premium travel options like carved up cabins, which I'll get to in a minute, and luxury lounges. So what's happening here with high-end travel? Carving up cabins catering to high-end travel and putting a price on nearly every aspect of the flying experience has helped large airlines haul in more cash from planes. And that's the reason, and I thought this was surprising, that Delta and United accounted for 85% of industry airline profits for the first 9 months of the year, the vast majority of the profits. What was once a race to offer the cheapest tickets, which we've heard about for years, particularly with Southwest, Spirit, and other discount airlines, is now about trying to stand out with a superior flying experience. And part of that experience involves redesigning the cabin. So from the Wall Street Journal article, this is the layout of Delta's Boeing 767-400ER fleet, which they use for international flights. And you'll see that they're redesigning the cabin. They're putting in much better seats, more room, more comfortable, that they can charge a higher price for. Well, let's think about the cash inflows and the cash outflows from redesigning the cabin that we just saw in the prior slide. So Delta cash flows redesigning a plane's cabin. There are cash outflows to spend money to redesign the plane. There are cash inflows from charging higher prices for seats. So let's assume that the cost is $10 million and that the annual increase in cash from selling premium seating for this plane is $2 million a year. Let's look at a 6-year time horizon. And let's assume that an annual rate of inflation or an accepted rate of return, it could be either one in this analysis, both terms could be used as 5%. This is a capital budgeting decision. Thinking about long-term spending and how you recover the cost of that long-term spending. So here's the analysis. Years 1 through 6. Year 0, at the beginning, we pay out $10 million, present value of $10 million outflow. Then using a 5% present value tables for the analysis, here are the present values for these years at 5%. And you can see that we're getting $2 million more in a year. We multiply by the present value, and we get a net cash inflow adjusted to present value. And if we add it all up, we see that the net effect of the cash inflows and outflows is a positive number. So the present value of the total payments is in black here. The present value at the end of year 5 is, if I click here, is these three. It's at a loss, but then when you add on the 6th year, we actually get a positive net effect. So at the end of 5 years, this decision to change the plane's layout is not cash flow positive, but we add on a 6th year, it is. So this is the kind of analysis that Delta is going to do to decide, do we spend the money to redesign the plane? So the takeaway here is that if you're making a capital budgeting decision, you're going to spend a lot of money and you're trying to do some long-term analysis, consider the cash outflows of the spending and compare them to the cash inflows over a period of time. Adjust everything to present value, and if the net effect is a positive number, the decision makes financial sense.